Good morning, everyone, and we sincerely apologize for all the mess, one with the invite and the next with this. So we can get started right away. So of course, we have Mr. Sam Subramaniam here today, who's going to speak about the venture capital industry. He is the president of private equity at Bajaj, and prior to joining Bajaj, he was the CEO of Brand Capital, which is the strategic arm of the Times Group. He, of course, is credited with restructuring and restructuring the business during challenging times and had achieved the largest number of venture investments and exits during his 5-year stint as CEO. Prior to Brand Capital, he served as a senior advisor for a multi-billion-dollar retail, finance, and insurance business. He also founded a family office called Sprout Growth Advisors and was the managing partner and board member of Julian Loki, the major US mid-market investment bank. Prior to that, he served on the leadership team of American Express, their strategic planning and business development group, and was an investment banker at Goldman Sachs. He has also served as an economic advisor to the Dalai Lama's Central Tibetan Administration and was the recipient of the Bharat Shiromani Award as Entrepreneur of the Year 2009. He's graduated from IIT Madras and holds graduate degrees from Vanderbilt University and the University of Chicago's Booth School of Business. So please join me in welcoming Mr. Sam Subramaniam.
Is it on now? Yes. All right, good morning. I know where you got that introduction, man. That's scary. It makes me look old. Do I look that old, guys? Hope not. All right. All's well that starts well, right? No air conditioning, first floor challenges. Finally, we are here. I'm glad. Do we have the same amount of time or is it a lot less now? Same amount. All right, good. Somebody give me if I talk too much, somebody put their hand up. I know it's a Saturday morning, weekend. And I know most of you are from finance, which means you don't have a good work-life balance, right? So, and then I also know it's the World Cup finals weekend. So I'm keeping you from your family and a Saturday brunch. So I won't waste your time. So I requested to Jugal to keep this a interactive session, right? I'm sure every one of you, including me, we've heard many speakers all our lives. Some famous, some boring, some good, some rubbish, and some amazing. All of it. I have. I'm sure all of you have. And I've given good speeches. I've given bad ones. But one thing I've never done poorly is when I'm asked pointed questions, the answers to which I know, I'll share it, right? That I don't screw up. So, and here I'm going to talk about a topic that is not my opinion per se. It is largely all facts and truths from my experience and actually also from others' experiences. So, keeping that in mind, I asked Jugal when he asked me to speak at this thing, to keep it a Q&A session, largely, because I've been to too many lectures and things like this where somebody stands up and gives a lot of speech, a lot of gyan, and then people want to ask questions. They understood some parts of it. They didn't get their own questions answered. They didn't get their own perspective or some ideas they have clarified, right? And then there's 10 minutes, 15 minutes of Q&A in the end, and then they go away unhappy. I don't want that to happen. So I'm going to just have 2-3 pages. These pages, there's nothing there, you won't know. It's all standard. This is just to tee off the discussion, and then I'll take your questions, okay? So have a thought about, I'm sure each one of you came here with some idea, some knowledge, or some view of venture capital investing in India or anywhere, for that matter. And you may have some questions. You may have some doubts. You may have some comments and opinions. So keep all that fresh and put it out. These questions are not just for me. It's for your friends. There are How many of you here are CFAs that are they're not finished with the final parts? How many? See, so they're quite a number. So those of you that are finished, you could ask those questions that'll be helpful to the others. And before I start, in the interest of full disclosure, I'm not a CFA. I don't know if that disqualifies me, Jugal. So I'm not a CFA. My boss, when I was young, and I joined financial services when I was, I think, in my late 20s, he said, I told him, should I take this thing? CFA, blah, 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 blah. And then he said, why'd you join financial services? Why'd you join Goldman Sachs? I said, to make some money. He said, then shut up and go make it. All right? So I didn't take time away for the CFA. I didn't study. So I didn't appear for the test. I might have failed it if I tried. I see, Girish, who's a member of my team, is a CFA. I know how hard it is. I know that you guys are all CFAs, so I'm humbled by it, to be surrounded by so many people who are so qualified. This is one common thing that I find after I moved to India now, 6 years I'm investing. Everybody that I meet, everybody that I work with, everybody that worked for me, they're all so much more qualified than me. This is the common thing. It is quite intimidating. Everybody has 3 degrees. If they don't have 3, I don't see them, okay? So it's quite scary. I meet them and they say, yeah, I'm CA, MBA, BCom, MCom. I'm like, dude, what have you not done? So it's like, it is quite intimidating. I'm humbled by it. I'm also fortunate that I'm able to work with this deep talent of people in this country. And I was just telling Girish, we are just on the cusp of the beginning of the hockey stick, right? Now, we don't know exactly whether the hockey stick has already started taking off or it's just before the hockey stick. It's somewhere there. This body of talent that we have in our country, and this is not just in financial services, this is not just in CFA, it's not just in STEM, right? It's everything. We just have an obsession to learn in our culture across religions. There could be any religion, Hindu, Muslim, Jewish, Catholic, everybody is obsessed with learning and education. It's all going to pay off in a phenomenal way, but we just need to reach that critical mass when the knowledge economy starts firing on all cylinders, and then it'll happen. So thank you all for taking the time. And so let me do a few pages introductory remarks. So this first thing, my own title is in the company is head of private equity. Some people have asked me, so that means you don't do venture capital deals. That means you won't do an early stage deal. There's no such thing, okay? For example, you take OBGYN. You know what an OBGYN is? Anybody don't know? Most of you dudes, you won't know, I think. Obstetrics and gynecology, right? They can deliver a boy, a girl, a C-section, a normal childbirth, anything. That is their job. My job is to invest, price risk, deploy capital, manage the portfolio, construct a good portfolio, and exit. It's the same thing, whether you're in private equity or in venture capital or an angel. Doesn't matter. It's all different pieces of the same chain. What I've done in the early days in my career was all private equity. What I did recently in the last 6 years was largely all venture capital. At the moment, the title is private equity, but doesn't really matter. It depends on the opportunity, the deal gets sized, the structure gets made, the entity gets decided, and the capital will be deployed, right? So that is really just a name, right? So put that aside for a moment. But I'm going to spend a minute. A lot of this is self-explanatory. In an early stage of a company, very early stage, the first few checks, they're called angel or seed or, I'm sure how many of you have written a little check for a company? Angel, group, seed investments. How many of you have already done it? Anybody here? So some of you have already done it, written a check. And that is the early stage company, right? And then there is venture capital. And venture capital is when the company gets a little bit more form, a little bit more structure. There's a management team. A company is set up. They have a business plan, all that stuff. And then you enter something called a Series A. Series A could be a revenue company or a pre-revenue company, right? Company as a product, company as a service. Company's business model is being tried. Company has revenue, right? Most companies in Series A have revenue. Or they say pre-Series A. Or they even, there's a new thing I hear in Silicon Valley now, it's called stealth mode or something. Stealth mode means, I don't know where they get capital from. I think capital is their own bootstrap capital, or maybe a couple friends give them capital. It can't be so stealthy if the people who put in capital don't know what it is, right? If you're starting a bagel shop and you want Jugal to invest and you won't say it's a bagel shop, it's something, dude, give me 100,000, unless he's your brother or your best friend, he's not gonna give you money, right? So you've got to explain something. But that is the very, very early genesis stage, right? And then it goes to Series A, and then on and on and on. The growth happens, revenue happens, business model gets fine-tuned. Company may pivot. Company may change business models. Company may fine-tune. Company may add products. Company will expand the team, talent, all that stuff, right? And you know this cycle. But what is private equity? How is that different from venture capital? Typically, the check sizes are much larger in private equity. The company is much, much more mature, right? When I was young, like many of you, private equity in the United States, where I learned this business, India really doesn't have private equity yet, by the true definition of the word. By the true definition of private equity, company has reached some massive size, and its growth is sort of tailed off, right? So then investors come in, they acquire the company, they put leverage on it, they run the company, and then they exit. So those are large checks, right? That is a typical definition of private equity. But these days, private equity could be $50 million, $30 million. In India, we even had people say 200 crores, 50 crores, 80 crores as private equity. That is actually growth capital. Okay, so when a company is growing and you're taking minority stakes, 10, 20% of a company, you're putting 100, 200, 300 crores, large amounts of money. Okay, you're growing, your capital is growing, you're not recapitalizing the company and things like that yet. Company's growth is still intact, company is growing and you are providing capital for that growth. So that is growth capital. Now, in the last 3, 4, 5 years, there's been this confusion between growth capital and pre-IPO and IPO and DRHP and all this sort of thing has entered in. This is all, some of it is euphoria, right? You will agree. But some of it is also natural progression because everybody wants exits for their investments, right? So they start and see whatever they can do. Okay, sometimes these IPOs are done prematurely. Sometimes they're done correctly to raise capital because public markets is one of the cheapest form of capital. One of the most expensive form of capital is to give your equity away and get venture capital. Okay, debt is nice if you can get it. So this venture debt is growing, is a growing category. But a company in Series A, Series B, or earlier than that is very unlikely they can get venture debt, right? But once the company has decent revenues, some visibility of an EBITDA positivity, right? And there are some players who come in and structure some kind of debt, where they'll give them some debt. Debt doesn't dilute your capital structure, right? You retain your equity stakes, but you're taking on leverage, and that is more senior to others. Other things in the waterfall, so you got now obligated to pay an interest, right? And pay the debt back before you take any returns on your equity at an exit. So the pressure is higher on the promoters, right? Typically promoters who do growth equity companies or even these venture companies that are earlier than growth equity companies, they're not so much balance sheet managers and financial managers of the financial structure of the company, they are much more product and service type people, right? In fact, some of them even struggle to build a proper team, people leadership, scaling the company. Those things are hard skills, right? You can't expect one person to have every skill. It's very hard. So then to throw on leverage on top of it is another layer of risk, right? So I generally mostly always stay away from putting on leverage in such early companies. But that segment called venture debt, I think some of you may know some funds like Trifecta and yeah, there are others who are doing it, but then they typically would do it to companies that are a little bit more well-developed in that spectrum. They don't go early. I've had companies very early in Angel Series A said, why don't you give me debt? I'll say, why should I give you debt? He said, what can you give me collateral? He said, my cash flow. I said, you have none. Right? So it is a chicken and the egg, right? So there is no really one right answer, right? It's a matter of looking at the situation, looking at the structure, looking at the possible options, looking at the sources of capital, what is possible for you to do and not do, and your own threshold, return expectations for the capital. If you're a fiduciary, somebody is telling you, what is your hurdle? You have raised the capital, you're going to pay them back. They have certain expectation, and you're simply a money manager in the middle, right? So you owe them fiduciary responsibility, right? So then you manage all these spaces, and you arrive at some kind of answer. Any questions at this stage regarding this? We'll work that through right away. No? Any questions? Yeah, please.
What I wanted to understand is,
yeah.
lately if you see, there is continuous raising of capital.
Yes.
And many times you see the founder is down to the black in terms of
Equity.
shareholding.
Yeah.
So how do you, as an investor, get comfort that the founder is still in the game and it's not just diluting it and letting the business founder?
Yes. This is a very, very good question. Your name, mate?
Prashant.
Prashant is a very good question. Very good question. All of you listen up. If the founder is happily selling stakes very early in this process, and founder has gone down by Series A, even Series B, down to less than 5%, 10%, what's in it for them? Please understand, guys, when you're investing in something as risky as this, every one of you have the ability to buy a CD or as Dara calls it, FD, fixed deposit. That gives you what? These days it gives you what, 7.5%? Yeah. So if you put it on your dad or mom's name and they're senior citizen, you will get another 50 bips, right? Come on. That's not the world's worst thing. That's decent, right? So now that is your threshold. In your mind, you should view that as your threshold. You should view it that way. Right, there is this other component of diversifying the portfolio away from a certain type of asset class. That is there. But you should at least get that, right? So then you should be targeting something like mid-teen returns in this portfolio, right? In these companies as an investor. Now, when this promoter is continuously selling stakes and down to 3-4%, what motivation will they have? See, the only thing you see when you buy a share, when you buy a single share of a company, some Tata company, some Reliance, some Microsoft, Google, whatever shares you buy, you are looking at the management and the people who are producing the EPS, their long-term healthy greed. That's all there is. Being long-term healthy greedy is a good thing, correct? Being ethical, have good ethical standards, and long-term greedy at the same time is a wonderful thing. Short-term greed is bad. It ends in a very bad way. Poor ethics kills you, guaranteed. If somebody has got poor ethics, they should leave this business immediately. This is the business of other people's money. The single most important thing that is needed in this business is ethics, not intelligence. Without ethics, any level of intelligence doesn't help, okay? And for most of us, such ethics is normal in life. So given that is there, good ethics and corporate governance and those sort of things, and long-term greed in combination, that is what you're looking in a management team when you're buying a share. Now, things like innovation, other things are very important, but you're assuming these two things. Somebody can say, I'm very innovative, I don't have any profit motive. Will you buy that share, man? Somebody can say, I have deep profit motive, I'm long-term greedy, but I'm highly unethical. I'll steal all the gains. Will you buy that share? No. So these two things are a given requirement in anything. Beyond that, there is things like service efficiency, good process, innovation, how passionate you are. Passion is really a bad word, huh? Because passion is like what? How do you quantify that thing? If you don't have these things, anything else doesn't matter. Now, if some promoter, some shareholders, they say that I'm very ethical, very good, I'm very smart, I'm long-term greedy, I want to create equity value. But at the same time, I've sold 90% of my company in the second year. Those two things conflict, don't they? So this is the point. I worry about it. I want the shareholding team of the company, the promoter company, I look for it. They should have a decent enough stake. By the time the company reaches a level of maturity where a lot of value has been created and they are diluted at that point, I understand that. I understand that. And certain verticals like financial services, like lending business, where capital becomes a very, very important bulky portion of the business itself, or you're talking about things like retail. You have to open retail stores and things like that. Heavy amount of capital required, right? There, I understand you'll get diluted faster, right? But then there, the company's value also increases faster. So when the promoter team is diluted to 20%, the 2, 3, 4 people, the company's value is 8,000 crores, then it's still a meaningful amount of money. The way I look at it is they should have enough skin in the game. If they don't have enough skin in the game, that's a worrisome thing. And somebody says, I'm very altruistic, I'm doing this deal for the good of humanity, things like that. Those are very, very noble ideas, but see, if the promoter is already fabulously successful and they're not doing this for making wealth for themselves, they're doing it with a charitable intention, then the thing is different. But 90% of them are not that. 90% of the companies are built to create wealth. Promoters want to create wealth. Of course, they want to create a product or service to help the market. You've got to pay attention to it. It's very critical. And when a company raises successive rounds of capital and the promoter team gets diluted, and the value doesn't multiply fast enough, that really worries me. At that point, it's a little too late. What can you do? If they don't get the capital, they can't survive, right? So then you're caught in that loop, right? But it's good to keep an eye on that all the time. I do. It's a very important point. You mean ESOPs and things like that? Listen, those things are there. They're all there, but ESOPs and all this cannot get you 20% of a company. I mean, they can give you little pieces.
ESOP is for employees. The founder themselves say that we will take some kind of certificate.
Correct. I mean, there are so many avenues by which they can increase their stake, company gets recapitalized, various things happen. But you've got to look at every one of those things one by one. They're all unique scenarios. There's no one way to deal with it. But the main story is when the promoter's stake falls rapidly to 3%, 4%. There are two promoters. The two of them together own 6, 7%. Company is in a little bit of difficulty. You worry. Yeah. You worry because what motivation do they have? And I'm not going to name names. I've had several companies in my portfolio where this has happened. And the promoters, in many cases, they just check out. And sometimes they go off and they do other things. Yeah. Okay? So then, because they also see what's in it for them, right? They've given their best shot. They spent several years, and they are there. So I feel for them. They've tried very hard. They've come very far, and then they've reached some point where they're facing formidable challenges, and it probably is better for them to do something else from their own career standpoint rather than fighting this battle. So sometimes they do check out like that. It happens. But those are all the risks in this investing. But as an investor, you've got to be conscious of that. It's very important. If you have an ability to deploy capital without those wrinkles, I would do so. I would try.
So, do you think there is a way that we can motivate the founders to continue to work for the company despite the dilution? Because that's the only way you can get your capital back.
See, this is my own experience. I know it's being recorded. In my experience, motivating people against their will is very hard. I haven't succeeded. I haven't succeeded in motivating any promoter of a company to do something against their wish. I've not succeeded in motivating my daughter to do something against her wish. It's very difficult to do. Motivating somebody to do something that is not natural to them is very hard. I am not saying it's not done. Perhaps some people are gifted at doing that and they do it. It's very hard to do. Okay? So you've got to align outcomes with your goals, their outcomes for the promoter and the outcomes of the company where you have invested have got to align, right? And then as best as possible, within reason. And when these two things are divergent, to still motivate this promoter to do something that is not aligned with what they want to achieve is very hard. It's very, very hard. I myself don't do anything against my will, okay, in my daily lives. So it's very difficult. It's a hard thing to do. If somebody can do it, power to them, but it's a very uphill battle. But to the extent we can, we've got to do everything in our power. What is the corollary to your statement, I would say is, given the promoter and the team have a certain motivation and the management team below them, do everything you can in your compensation structure, in your team structure, how you reward them, how you pay them, or the work environment you give, all of it, to the best possible alignment. You have to try and achieve the best possible alignment where their outcome expectations, and the outcome of your actions get aligned to the best possible. It's very hard to do. While we are saying this, because, for example, company can say, I want to cut costs. I want to save money. All right? No drinking water bottles for you. You've got to use warm tap water and cool it and drink it. Small thing I'm saying. No tablecloths for you. I could say whatever. You've got to agree with it mentally. You may not say anything. You may all be my team. I may think that this cost cutting is very critical. But I may focus on the few trees and I may miss the forest. All right? It's very important to keep my eye on the big outcome, right? And so I can't miss the forest for a few trees. So it's very critical. And I've seen too many companies in my life make those mistakes. This cost cutting is something during a downturn many companies overdo. They do the wrong things. Cost cutting is sensible to do when a company is going through challenges. But what are you cutting? Where are you cutting? How are you messaging? How do you control those costs? These are critical. Okay, the promoter himself, and I've seen this, venture capitalists come and meddle with the company and do things like this. The promoters themselves may want certain they may have created an environment of camaraderie, ordering lunch. This happened in some companies during COVID and post-COVID. They ordered lunch, they got them free lunch and everything, gave them DoorDash coupons and Zomato coupons and things like this. You can have free lunch. And then hire a generation of people and they're all working and suddenly your costs became too much and then you say no. Suddenly one day. Now, the promoters themselves have bought into this completely. And then it's those promoters who have to go back to their own employees and say, no more lunch. Now, keep in mind, what kind of a situation are you putting them in? They've hired all these people. They hang out with everybody like brothers and sisters. Next thing, they have to say, no lunch for you. It's hard. It wrinkles, and it creates tensions between the investors and the promoters. So all these things happen, but these are real-life problems in investing. That is why this job of venture capital, I don't know how many of you are thinking about it. It's not an easy job. It's a very arduous job when the things take a downturn. When things are all going up, it's outstanding. But motivating them is absolutely key. You have to do everything in your power to do it. So, toggling to our Indian context. I don't know where in this hockey stick we are at. We are somewhere on this hockey stick, right? I remember the mid-90s when I first started observing venture capital come into India, the early funds. It was very early, very green, few deals, few and far apart. It started picking up a little bit, 2001, 2, 3, post 9/11 and things like that. But those days, majority of the investments were things like this BPOs and all that sort of stuff, right? KPOs, BPOs. I'm sure you remember Office Tiger. Some of you will remember WNS, which is nearby. Genpact. You remember some of these companies, they were all small in those days, right? And then today, you know your big baskets and blah, 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 Swiggy, Zomato, you know, so many companies. Have we begun the hockey stick? Are we in front of the hockey stick or are we on the hockey stick? We don't know yet. It's very hard to tell. We'll only know that after we are on it, for sure, to be sure. But the trend is like this, and the trend is non-linear. So if you go back, the important point to know that this venture capital thing is not a new thing. It's always been there. If you rewind 100 years ago, there was venture capital, right? I mean, our big companies in this country, at some point of time, Maruti was venture capital. Suzuki put in money, the government in India put in money, and we built a company. That's how it started. So everything starts with a small amount of money and a business plan and a small team, and then it grows and it scales and things like it. This is not an all-encompassing set of deals or anything like that. This is just some representative deals that got done in that decade, right? But there were billions of dollars invested in that decade. It's not like venture capital just started now. It's not a new thing. It existed then. You would recognize some of these companies. Some of these companies are massive now, right? Many of you would know Naukri. I had investments in Mufti, right? You must be using Make My Trip. There are several companies here. Fab India, I'm sure many of you have visited Fab India. But Fab India existed before that. Fab India existed before 95. But the thing is, companies, venture capital existed. Capital going into companies, funding growth existed very well in those days. But they were not that common. And if you see here, a lot of these were B2B companies. Look at the type of companies, a lot of them. And then you swing a decade later, the volume of money that went in multiplied. Now, they asked me how much, and the team couldn't find the exact dollars between venture capital and growth equity and private equity. I said, it's irrelevant. It is irrelevant for my purposes. Whether you call it venture capital, growth equity, private equity, angel seed, irrelevant. It is just that the ecosystem of capital formation and company formation and growth is alive and well, right? That I take comfort from, right? So there are so many companies that got invested, and many of them are stars today. What we don't know are, for everyone that's a star, there's 5 or 8 or 10 that you don't know. But those are as critical as the stars. Think about it. right? You won't produce a Nobel Prize winner in physics unless you start with millions of youngsters and teach them physics for a long time. And then you produce a Nobel Prize winner. And no Nobel Prize winner does her or his Nobel research alone. There's a large number of other physicists who are working with this person to do some research, and then an answer is arrived at. So you need an ecosystem. Without an ecosystem, you don't produce an Ola. You don't produce an Uber. You don't produce today's stars like Oyo and Aether. I mean, big companies here, right? Zomato, Flipkart. You don't produce these stars without the ecosystem. And the ecosystem is very critical, which is why this portfolio construction becomes very important as a venture capitalist. Because you can never choose only the winners and invest in them. It's impossible. No matter how hard you try, if you handpick, cherry pick 3, 4, 5, 8 companies and say, I'm done, they will be winners. It's very hard to do. Because a company can go bust in early stages of its life for so many reasons, right? So, and you can't control all that. The honest truth is you don't control most of that. Even the promoters cannot control a lot of that. Something like COVID came in and it wiped out how many restaurants, how many food companies. Who could have foreseen that, right? So it's very, very difficult. So you need to construct a portfolio where a few do extremely well and some do okay, and then a bunch will go bust. That is the life cycle of the business. And that requires a certain appetite from the investor community to deploy capital. Okay? The investor community has multiple asset classes in which they can deploy capital. At the lowest risk end, there are treasuries, there is sovereign bonds, there is your fixed deposits. Those are like what we discussed, 7.5%. That is your threshold. And then at the other end, among the most risky, single company risk is what we are talking about. This entire spectrum is there. So as a money manager, they have to look at all these segments of asset classes and take a risk, take their risk in an organized, structured, calculated portfolio way. And then what they do, what they get here, a large portion of these alternate assets, they call these alternate assets, whether it's venture capital, private equity, real estate, those are not always completely correlated with the market. They do have a correlation with the market. It's not like it is zero, but several of them grow counter to the market too, right? For example, if you take a ThyroCare, the company that draws your blood and comes home, they take your blood sample and then they give you results. Look at that innovation. Earlier you had to go take a rickshaw or take your motorbike or your car and then go give sample and come back. It wasn't easy. Today they just come and they do it. You pay some extra money perhaps, but you get a service. They email you on your WhatsApp the result. It's very, very seamless and fast. And that's why that industry grew. Tremendous innovation. The total number of tests, blood tests that people do today when they go to a doctor. Today, doctors prescribe blood tests very easily. Okay? When I was a little boy, doctors didn't even check your blood pressure when you went to the doctor. They just checked this and then they wrote something and gave you. Today, they write a blood test because it's a lot easy to do too. Of course, we can afford it as well. Our ability to spend money for it has increased. That is the truth. But these services exist. So it is very important from a portfolio constructor standpoint to look at the full spectrum of risk. And it is very important from the individual company standpoint to understand their business model well. Both those things have happened much better, decade after decade. And we saw many, many more investments. So people's appetite to take risk increased, right? When I was young, you couldn't get a home loan in India. Today, home loans are plenty to borrow. So economy changes, people's appetite to take risk will change, will evolve. And capital formation happens for every asset class as a result of all those changes. The overall economy is also growing. All these companies are formed, okay? So, and then you go another decade, Many more companies happened. And the total volume of capital that went in increased non-linearly. I don't know what this number is. Girish, this number is like 40, 50 billion dollars, something like that per year in the last year, right? A couple of years ago, before COVID. Not Girish, Jugal. You mentioned that, or somebody mentioned that. The number was like 40, 45 billion dollars, and I'm sure a billion here, a billion there is left not counted. Yeah, so the real numbers are very large, right? The truth is some of it is not venture capital, some of it is growth equity, some of it will be private equity. Doesn't matter. Companies are getting capital, which means people are willing to open their purse strings and deploy money and take that risk. That is good for the ecosystem. For every one company, BlueSmart, it was on my table. I wanted to invest in that company pre-COVID. I really wanted to. We didn't reach the finish line. I really understood the value of it. That you guys know what BlueSmart is? BlueSmart is basically your Uber with electric vehicles. Okay? Basically your car hailing in electric vehicles. Now, a huge number of people. Now, Uber has a service called Uber Green, right? Ola perhaps has something like that. But at that time, BlueSmart was one of the earliest in that. And basically, it was a bet on the fact that a huge number of people in the market will want to go in green, transport themselves, go A to B in a green way. And that trend is increasing. How many of you used Uber Green? Ever? None of you? I have. In the past couple days when we took Uber, I asked for an Uber Green. Okay, the option is there. When the option is there and the price is similar, you use it. And this is how trends start, right? And BlueSmart, company out of Gurgaon, is quite popular. And it's growing across India, and it's grown really, really well. I don't know what their value is today. But if there was no Uber, there was no Ola, then there is no BlueSmart. Think about it that way. The car hailing business started. And BlueSmart started on top of Uber and Ola, right? Now, that is how this ecosystem gets built. And capital comes in. And new services, new businesses start. And we change our buyer and user habits, all of us. And we start buying things. Remember, before Tanishq became so big as a gold retailer, and then many others are there now, if you look at how your parents and your grandparents shopped jewelry, it was much more disorganized. Today, it is far more transparent, far more organized, structured. You know your value better, you have certificates. It's much more easier. And so many more people come in and complete transactions. So the overall market also grows. So that's one important thing you've got to keep in mind. It's not just investing in venture capital, making 5x, 6x returns. That thing is all there. But you're creating buyer behavior. People's consumption behavior is getting developed, and it's on the margin changing, especially in B2C companies. B2B companies too, they're changing processes altogether. The SaaS model never existed 15 years ago. I don't know the exact number of years, but SaaS model was very rare. Today, cloud and SaaS model is the bread and butter of any major company scaling. And that allowed many of these companies to scale much faster. Otherwise, they'll be dealing with buying computers, software, deploying, dealing with it, scaling. Now everything is done on the cloud. It's much faster, more seamless, right? Now, with it comes security problems. Internet security, right? Data security, many problems come. And then youngsters like my daughter who are studying that, they get a career out of it. Data security, internet security, and things like that. So the whole ecosystem develops. As the ecosystem develops, more and more opportunities develop, and our ability to deploy capital in them increases. And that is the non-linear increase. I've not told you anything you don't know. All of this you know. All of this you're using, all of this you are spending. But I'm sure many of you have questions and thoughts around the fact that this whole thing melted post-COVID. During COVID and a year after that, the values just went up and the whole thing melted. All the capital is gone. There is no venture capital available, Sammy. No. None of that is true. None of that is true. We have had a lot of wins, right? Every table, tell me 2 companies you guys think in your recent memory that are successes. We'll start there. 2 companies that you know that are successes, venture capital success. Loudly. Licious, okay. Aether. That table. Aether is electric bike, Licious is non-veg. Huh? And middle table, in the back. Loudly. What's that? Loudly, like zor se. Coco FM.
Yeah.
Okay. Somebody else? Only one company in that table? Zomato. Here. Cred. Cred is successful. Okay. And then? Nika. Yes. Ease my trip. Pepper fry. Okay. Did you buy the stock recently? It's done well recently. Swiggy. There? Urban Company. Oyo. Good land. Good land. There's a backstory. Okay. Dream11. Yeah.
I have a question. Okay, it's from the retail investor point of view.
Retail investor. Matlab, listed stocks, buying listed stocks. Yes.
And really, if you go a little deeper and try to understand them, a lot of time you will find that it's offer for sale.
It is what?
Significant portion is offer for sale.
Yeah.
And
Meaning the promoters are selling their shares.
promoter are initial investors. They are
selling, exiting.
Okay, exiting. And it looks like, okay, the initial investor, promoters and other people, they are exiting, they are creating the euphoria and exiting at the cost of the retail people or the IPO people, public. Looks like, it's not, I cannot back with solid data, something like that. But the way the lot of people have seen, the lot of companies have gone busted after IPO, it gives that kind of impression.
So what's the question?
So what is your take on that? Okay, why it is happening like that?
See, it's what people's motivations are is hard to calibrate and hard to talk about. But as a venture capitalist, what is our intention? We are taking a risk, constructing a portfolio, and we want to exit at some point of time. And we are in it to make a return, correct? So it is normal when we get a chance to exit, whether it's selling to some other buyer, strategic, another venture capitalist or private equity or IPO, doesn't matter. It's normal that they look for an exit. Very clear. A venture capitalist relationship with a company is not like a parent's relationship with a child. Child is forever. Okay? You start a company as a promoter, it's your company. That is different than for a venture capitalist. A venture capitalist has invested not to stay in that company for 20 years. No. Do they stay 20 years? Has somebody stayed 20 years as a venture capitalist? Maybe. But that is not the normal set of deals. Normal set of deals, they want to exit in some point of time and produce a return. So it is totally normal and natural that they seek an exit, and they should seek an exit. It's very critical. In fact, some of the best venture capitalists are not just people who know how to do deals, how to enter deals, is how to exit deals. Exiting deals is as important as entering deals, okay? That's from a venture capitalist standpoint. from a promoter standpoint of these companies that we talked about, you're talking about some of the pains in this now. I knew this page will automatically take itself to its answer because people have felt wins, people have felt pains, and they will ask, okay? And all of us have learned, all right? Promoters too. There are some promoters who build companies, say, I'm very passionate about it, I want to change the way drinking water is given, I want to change the way eyeglasses are worn by people, I want to change the way education is provided. Yes, there are. But there are also a large number of promoters who say, listen, I want to produce this company, I want to grow it, I want to succeed, I want to make it a 20x, and I want to exit. I want to make a lot of money, and I want to go fishing. Fine. It takes all kinds. There's nothing wrong. It is our job when we take risk as an investor, in this case, as somebody who's buying shares in that IPO, to price that risk the best of our ability, okay? If we can't price that risk and we have doubts, we should not buy it. But that promoter who is selling shares into that IPO and taking some cash out, which is called a, whatever that is called. I don't know these acronyms, all of them very well, okay? Or the venture capitalist who is exiting. To me, that is expected. There's nothing wrong with it. Keep in mind, if the IPO is listing at like 200 rupees a share, the promoter's basis is 1 rupee a share. At that point, the promoter has made a decent return. The venture capitalist investment may be at a 50 rupees a share. Venture capital is getting 4 times return. Venture capital is happy. They want to take some money off the table. Promoter's happy. Promoter wants to take some money off the table. Keep in mind, guys, one thing I will tell you, I'm telling you data and knowledge without naming names from an earlier genre of listing from 98, 99, 2000. I have some experience from that period as well. I had hair, I was young, and I've seen the earlier tech boom in Silicon Valley, all this. Some promoters were living in 1-bedroom, 2-bedroom flats, and they had built what we call today unicorns. They didn't have that name then. These companies had billion-dollar valuations, okay, upon listing. And they were living in 1-bedroom, 2-bedroom flats. Let me tell you, how many of you here are older than 40 and living in 1-bedroom flat? Be bold and put your hand up. Answer 0, right? Correct or not? Yeah. But they are. They were. They had worked on their company for 8, 10 years, worked really hard. Their family was living in a 1-bedroom apartment, 2-bedroom apartment. Now, what is wrong if that promoter sells a $20 million, $30 million worth of shares in that IPO and then makes a home for themselves and buys a couple cars and they live nicely? So there is logic and there is sense for that. But there is also this other side when the promoter owns 4% of the company at listing, like you said, and they sell 3.8 of that 4%. Now that is a worrisome thing. Okay? So if I am buying shares in an IPO, I will want to check that. How much is the promoter selling? How much are the venture capitalists selling in this? What does it look like? So one has to take a look and then make a decision. But I will be humble to say I have never, ever in my life, and I made a lot of investments, large number of investments in different markets, in different countries also. I have never purchased a single share at an IPO. That is not me. That's all. And I'm not saying it shouldn't be done. I don't trade. I don't go in and out. I don't buy something and hold on to it for like 3 months and sell. I buy and I hold on for a long time. That is me. That's my style, and that's what I know to do. So I do what I know to do. What I don't have a good, strong appetite for is to go in and out really fast. No, I just don't have the temperament for it. So I think if you find somebody who is a IPO trader type person, they may have some unique views on it. But I will say, as a venture capitalist, to exit in an IPO is totally fine, totally par for the course. As a promoter, to take some chips off the table is par for the course. But if a promoter is selling 90% of their whole stake in an IPO, it's a yellow flag for me, all right? So and then if I'm buying the shares, those shares, to hold on for 3-4 years, then that's a real yellow flag. So I'll wait for that IPO to come on and be in the market for some time and see how the shares are trading, and then take a stake, okay? And as we know, there were many IPOs that happened in the last 3 years that all went up, and they became much cheaper to buy a little bit later when the euphoria settled down. So listen, the important thing I would say about venture investing versus this IPO style thing, this is not venture investing. When you ask that question, is that the right thing to do? That's not so much venture investing. That is now, at that point, you're talking about trading, holding it for a period of time and exiting, or buying for the long term. That's a portfolio construction on the asset management side. People do take IPO positions, obviously, otherwise these IPOs won't get filled. People want to get in. And for every one IPO where the promoters are selling a large piece, there are 8 where they are not, okay? 8 or 9 out of every 10. Only very small cases where that happens. I mean, listen, I would avoid it. Just stay away, just to be safe. You know what I mean? Because that extra return that you could potentially get is not worth that downside, in my humble opinion. So I'll stay away from that one, wait for a little period of time and see how it settles. And then, take that risk. Yeah. Grab that microphone so it's a little easier. I'll give him a microphone. Yeah.
Thank you. So, I wanted to ask you is that I'm from the asset side of the banking, right?
Your side, what side?
I work for a bank and I'm on the asset side of the banking.
Asset side of banking?
Yeah. So before lending, it is very important for us to, evaluate in terms of what is the kind of skin the promoter has in the business.
Lending?
Yeah.
So that is debt?
That is debt. Okay. So be it in terms of working capital or for any kind of a project, even the government is also coming up with a lot of policies in terms of funding these startups and all those stuff. For any kind of 2 aspects, which is, we out of the experience of 10-12 years, one is very important for us in the banking industry is that to evaluate the skin in the game, right? If you look onto the, I'm trying to compare it from the era which the PPT you were showing, right, from 1995 to 2023, even 2020. So in terms of 2 phases, if I distribute it, one phase is the first generation running the business. How is the second generation compatible, running the another side of the
Hold
business?
a second, say that again.
One is the first generation running the business, and how efficient is the second generation running the business?
What does that mean, second generation? You mean like...
I'll not name the company, but...
No, are you talking about company changing hands from one generation in the family to another generation?
Yeah.
Okay.
So over there also, there is a venture capital which is involved, right?
You're talking about large mature companies changing hands?
No, not at all large company. It is totally, in terms of lay terms, it is a Lala-driven company. Okay.
But that is not venture capital then?
No. There is an involvement of venture capital. I am doing a transaction right now.
Oh, you're talking about a live case of something unique.
Yeah. So my question to you is, see, our perspective is that if we are putting that kind of money, the money is on a very large scale. If the debt is there on that project, on that greenfield project, the first generation has that guy has given birth to this company and he has some kind of attachment,
Yeah.
right? And then he has taken it on that kind of passion, and he has also disinvested his equity share and also invited venture capital to that company. Now the company is looking forward to some kind of debt. So for our perspective, it is very important, to see that if the first generation is so much involved and the first generation is, running this business for next another 5 years, and our debt are to the tune of 10 years, 15 years. In that case, how do venture capital, evaluate in terms of see, important is what is the skin in the market, right? What is the skin in the business?
See,
But
you're
when
saying
you-
that the
when you
first
s-
generation has already brought in venture capital into the company.
Yeah.
And
the second
number two, the
generation-
second generation is taking over now.
And how compatible, because see, there is always a generation gap, thought of generation gap, right?
Yeah.
There's always a gap. So my
And
question,
then now you're talking about putting debt into the company
Yeah.
at this stage, and venture capital is already there.
yeah,
How much of the company is owned by venture capital?
sir, almost 30%,
30%. They have minority
30,
rights.
32%.
They have minority rights. They have board
And now,
seats.
yeah,
They have
now
board
the
seats.
second generation is willing to shed out another portion of the equity
To venture capital.
to venture capital,
For capital into the company or capital out of the company?
capital into the company,
For growth.
yeah, for growth.
Okay.
So
Okay.
see,
And then you're going in with that venture capital with debt.
see, the customer is our existing customer, and we have been
Yeah.
into this business with the customer for last 10 years.
Yeah.
So even it becomes difficult for us to come out of it.
Yeah.
So it's something in Hindi, ab
See-
nigla bhi nahi jaye aur ugla bhi nahi jaye wali halat.
See, the thing is, you're talking about real problems in underwriting debt when you're putting in large amounts of capital into companies that go through generational changes, like what you're saying.
My question to you, sir, is that since financials and all those part are different, those are papers and numbers. Important to me is, how the promoter is going to take this company. Like for example, it is very important in the debt market that कि मतलब लाला कितना involved है business में.
See,
और venture capital में when you state this kind of example that I want to sell off this company and go for a fishing, then it is people's money which is at stake.
no, hold on. Hold that thought. No, it's not. Let me explain to you. When I build a company, let's say I'm the promoter,
Okay.
and he's the venture capitalist. He has given me money. I pledge to him that I'll take his money, I'll put his money in the company, I'll grow the company. I'll build the product, the service, I'll increase the revenue, I'll increase the profits, I'll do whatever. Now, this venture capitalist at some point will sell his or her stake to somebody. Okay, then they go fishing or whatever with their money, with the gains they made, that's their lookout. At some point, me as a young promoter, typically understand your example is not that. Your example is a multi-generational company. Okay? These companies, that examples, most of them we talk about where the venture capitalists came in, they are not multi-generational type companies. Typically, their companies started based on a technology, a product, a service by a group of entrepreneurs. Most all of them are first generation. Very few will be the second generation of a large family that spun off from there. The family capitalized it. Other people came in. And then the company grew. Very rarely you find this kind of venture capital that we are talking about today. Private equity is separate, okay? What we are talking about today, venture capital, very rarely do you find traditional businesses in lumber or in steel making or in concrete making. Very rarely. Those are not innovation industries per se, okay? And I'm not saying there isn't innovation in steel making or there isn't innovation in concrete making. Those are unique cases. But majority of this venture capital are people in the first generation who are starting out, and that's what I have done. Majority of what I've done is that, right? Now, What you're talking about is growth capital, established companies, good companies, growing, they already have debt, and they can take on more debt. But that's not your typical bread and butter of what I'm focused on here today. But to answer your question, whether I'll put in more debt or not, if I am forced to make that decision, I would spend plenty of time talking to the two generations of the entrepreneurs. Okay? The strategy is on that transition. That is core to it, okay? If that promoter there, you're putting in debt, and that promoter is going to sell and go off. One generation or both generations. That is worrisome, man. Because you have put in debt, looking at the first generation promoter, and you have done well, you have a long relationship. Now there's a transition to the second generation promoter, and you have to spend time with this promoter, second generation promoter, and understand. You're, yes. Venture capital. See, majority of the exits in venture capital is not IPO. If you take 100 deals in venture capital across different markets in the world, I don't know what number will be IPO. It'll be less than 10, Girish. IPO is not majority of the venture capital exits, okay? You hear about Zomato IPO, you hear about Nike IPO, you hear about certain IPOs, and they make a big splash. So they get a lot of news coverage and things like that. But majority of the venture capital exits is to other investors, right? Or to strategics. That is where the exits happen. So I'll give you an example. People come in different stages of these companies' lives. So for example, there is a type of asset manager, I'm not talking venture capitalist, who is willing to enter a company at IPO, the example he gave. There is a different type of asset manager who is only willing to come in after the company has been post-IPO for several years. They have checked the stock, they've been reviewed multiple quarters, and they've produced earnings multiple quarters, everything is set and stable, and then they come at that time. In which case, they're probably paying a higher valuation, but they are fine with that. These people are willing to take this extra risk, and they're fine with that, right? So there are different people who are willing to come in different stages of these companies, and they price their entry risk, and they also have a fairly decent view as to when they will exit, right? Now, you in venture capital are very early in this formation. They can come and buy it from you. So within the venture capital spectrum, there are some companies which focus on angel. There are some which are Series A, Series B, and then there are some that are Series C, D, E. Some do pre-IPO rounds, they call it. They take the stake from a venture capitalist before an IPO. They aggregate a stake, and then they go into the IPO. They are hoping the IPO will pop, and it'll make some money, and then they'll hold on for a period of time. So there are all these people who come in different stages. They buy it from you. They buy it from you. So for example, I'll give you an example. There could be an early stage guy who is like in Series A, who are willing to put in $1 million, 5 crores, 10 crores into a company. That's it. That's their bite size. But somebody else may have a bite size of 50 crores. There's a larger fund. So what they will do at some point of time, if this is 3-4 years out, this 5 crores, 6 crores has now become 12 crores in value. Value has gone up. This person comes in. This person says, I want to buy 3 of you out. 3 people are there. 15 crores is 50 crores. Now I can build my 50 crore stake in the company 2 ways. One is if the company is raising growth capital, I can put in growth capital into the company. That's a primary infusion of capital. But at the same time, let's say my bite size is 100. I put in 50 crores into the company. I buy another 50 crores from 3 venture capitalists who are exiting. But they are fine with it. They put in 5 crores into the company. Now it's worth 12, 14, 15 crores. They made a 3x in 3-4 years. They're happy. They're fine exiting. And this other venture capitalist has come in and bought. So majority of the exits I have done in my career are to other venture capitalists, our private equity funds, or hedge funds, or family offices. And in some cases, the promoters themselves want to increase their stake. It's opposite of your example where the promoter is selling out and going fishing. There will be cases where the promoter wants to increase their stake. I have sold stakes back to the promoter at some point, right? They increase their stake. So very few venture capital companies have IPO as an exit. And very rarely will somebody who went in a very early stage, angel or series A, wait till the IPO. That may be 10, 12 years. It happens. I'm not saying it doesn't happen. But majority of the institutional capital in venture capital or different stages of venture capital, they exit before that. They may not have a 15-year time horizon for IPO. Okay? In some cases, IPOs happen in 5 years, 6 years. It just goes. It just flies and it happens. Then it's fine. Okay? So IPOs, it's a misnomer that IPOs are the only ways to exit. Majority of the exits are to other investors who want to put in a larger amount of money because that's their own investment style, or they're willing to take that risk. Keep in mind, let's say, I'll give you an example. How many of you follow cricket? All of you, right? Okay. Shubman Gill. Name rings a bell? Okay. Go back to 2013, 14, 15, whatever, that period. I don't know him that well, but I know he was a rising star at that time. But nobody could have guessed is going to become so good and an opening batsman of our team and so important in the team. Not nobody, maybe somebody guessed it, but not many would have known he would be so good. I myself didn't, but when I started seeing him play after that under 19 thing, it was like incredible, right? So somebody, let's say instead of an athlete, okay, this is a company. Like how he rose, let's say it's a company. At this stage, somebody is putting $100,000 into that company. But then somebody else comes at this stage. Later, today, Shubman Gill is far less risky as an investment than it was in 2015, right? 2015, you could not have guessed and predicted how well he will play. Today, you have a much more formed view. You have seen him play so many matches, difficult situations. He's a match winner. Zero doubt about it, right? Anybody have a doubt? He's a match winner now. The discussion me and my brother have is he going to become a Sachin Tendulkar one day? This is the discussion we are having. Now, maybe somebody already predicted that in 2014-15, but most people could not have predicted. Today, the risk is lower. Today, you can see the path much better. That's the same thing in a company. Early stage in a company, you can't see that stage. And in 3, 4, 5 years, you can see that stage come, if it's going to come. So what that means in practical capital allocation terms is the risk is higher here, and the risk is lower here. You understand what I mean? So if you have 2 crores of your savings, let's say that's all you have, you're going to invest. You may be of the view, 60% of my money, I want to put in less risk. Sleep well. 40%, I'm willing to take more risk. Okay? 25% of that 40%, just 10% of the total money, I'll take high risk. Okay? So 60% is low risk, 30% is modest risk, 10% is high risk. Okay? So what do? You buy fixed income. You buy fixed deposits, government instruments, things like that for your 60%, your sleep well money. Your 10%, you put in venture capital type companies, which means it can go to zero, or it can become a multi-bagger. Your 30%, you go into good, nifty names. You buy good companies, well-reviewed good companies with good earnings, good growth, you buy. where you expect to get returns. This is a portfolio construction. So now, if you have 2 crores to invest, your 10% is what? 20 lakhs. Well, what if you have 20,000 crores to invest? Your 10% becomes 2,000 crores if you're managing capital. So then that person will now have to choose, my 2,000 crores is going to be in 50 deals or 100 deals or 10 deals. Think about it. If they're going to do 50 deals, it's a certain bite size. If it is 100 deals, it's a much smaller bite size. So that's a lot more effort and a lot more work to screen 100 deals and deploy. So they wear on a hat. Then they decide, okay, I don't have time to screen 100 deals, so I will go and find funds. I will put 100 crores in this fund, 100 crores in this fund, and those fund managers will manage that. Those are called fund of funds. So my point I'm saying is, depending on your appetite, you will have a bite size, right? And your size, your appetite for risk and your size. So there is always somebody who wants to take a lower risk at a higher bite size that is waiting to buy your stake. You understand? So you put in 15 crores today in one venture capital company, your venture capital company, a venture invested company, you put 15 crores today, and then after 4 or 5 years, things have gone well, that 15 crores is worth 40 crores. Stake has done well, company has done well, somebody else will show up at that stage during the next capital raise. They'll come and say, okay, I'm going to put 400 crores for this company to grow as primary capital, for which I'm getting 20% of the company or what have you. But I will also buy 4 or 5 other guys and put another 200 crores because I have a very strong view of this company. So they will take my stake and give me 40 crores. I'm happy. My 15 crores is 40 crores. I'm happy. I walk away. This person has put in a stake of 400 crores into the company and another 300, 400 crores of secondary. So they have a 700 crore stake. They may be happy waiting some years and taking 2,000 crores out. I don't know. So those guys, that is majority of the exits.
Sir, don't you think that the SME listing which is happening, so what you said is the organic way of any company growing, right? The promoters start the company, the evaluation of the company, the company develops, and then the private equity investors or the venture capital company comes in, they grow the company and take it on a different level, and then the IPO goes in, and the retail investors comes in, and this is an organic way of what we have been seeing in the market, right? But now SME listing has coming up. So don't you think that a company which has grown over 5-10 years and now going for a listing is somehow hurting the retail investors or somewhere venture capital industry?
No. I don't think it's hurting. SME is something I don't have much knowledge about. SME markets, capital market, it exists and it is growing. I don't have a view because I don't know it that well. But the venture capital market in India is strong, alive, and well. My next page will talk a little bit about that. It is there is enough breadth there, and the breadth is only increasing. I'm sure the SME market will come in and add to that as time goes on. There'll be more and more breadth and depth in that, and more deals coming, and more exit opportunities coming. But I don't for a moment think that a promoter selling a stake or a venture capitalist selling a stake in an IPO or in a secondary stake is a wrong thing. That is how the tree grows, the tree gets pruned, and then the tree restarts again. Because keep in mind, the venture capitalist also has to raise another fund and then deploy more capital into the market to help the market grow. If the venture capital holds on to this portfolio and never exits, how will they sustain? Their job is, see, you probably have children, correct? Your children will go to university, they will get a job. They'll say, Mama, Papa, I want to go to America, Canada. If you say you never go, you never build a company, Who will make the next Google? You've got to let them go, right? At some point, you can't tell them they have to live with you till they are 55 years old, even though that's what I would like. But it's very hard, right? You've got to let them go. That's the same thing in this, in a manner of speaking. As a venture capitalist, your job ends when you have taken the company out of that phase to a larger phase. And then you go. And then you find the next target to do. Because people have specialization in a certain type of company investing. It is not unlike school teachers. Somebody who's a kindergarten, first standard, second standard teacher teaches that class. And then the child goes to middle school, then the child goes to high school. There is different teachers who come in who have different skills and they teach them and they keep moving. And that is natural. So a venture capitalist exiting a company, I will be honest. There are companies I have exited, which I shouldn't have, okay? Which have gone on to do well. They've done even better. There are companies that I exited, multiple, in the last couple of years, after COVID, during COVID, which was great timing. Great timing. Did I know that was great timing? No. You cannot know. But you've got to look backwards and say, listen, I put 100 rupees. I waited 4 or 5 years. Today the 100 rupees is 350 rupees. I'm making a decent return. I'm long-term greedy. I'll take my money out. I'll find some other opportunity to deploy. This is the hygiene. The hygiene is not to say, oh, this deal has to be 80x, I have to be in this. See, if you keep looking like that, you will never build a portfolio. You've got to continuously you've got to have a proper discipline to create a proper venture capital company. This is something that is in my next page. This is amongst the learnings of this. There are people who didn't exit, and they thought they will get the 30x, 40x, and some of these companies, the venture capital market changed, the exit market changed, and today there is less funds, and they're not finding enough chances to exit, right? They're sitting on gains, some of them, and sitting on smaller gains. If they were sitting on bigger gains, and now it's smaller gains, it's all paper gains, right? So now they are not able to produce an exit. So it's very hard to time the market. In my experience, I don't know. What is the silver bullet to time the market? But all I know is if one has a certain good investment discipline, understands their investment focus, this is what I'm good at, this is what I want to do, okay? This is how I size this investment, this is how I price this risk, this is how I evaluate a good management team, right? I do all those things, I put in money, I made a decent return, and it's a fair, good return, it's fair to my shareholders, and the effort we have put in, I find a good exit, I walk. I don't have this feeling that I have to sit in it forever and maximize every single return. You've got to think about a portfolio optimization as a venture capital business leader, and not just a single company alone. That's a different task. Running a single company alone, maximizing, is the entrepreneur's task. Okay? As a venture capitalist, there are so many stories I can tell you where exits were not done at a reasonable time frame and money was lost. Value has gone down. This has happened. So it is like all these companies, young companies, when they grow, there are exogenous factors that can hurt them. It is not just the promoters making a mistake or a company doing something wrong. COVID came, right? Think how many companies in F&B went bust during COVID. Correct or not? Post-COVID, the business came back, but if your restaurant has gone bust, it's not like mysteriously in 2021 when everybody started coming out and eating, you can have a restaurant. The whole thing has gone bust. Nobody came to eat for 2 years. You don't have staff. You don't have anything. You're gone. So that can happen too. Or in technology, something else can come in and supersede you, or 1 or 2 mistakes in strategy or execution can hurt you. So as an investor, I would encourage anybody who wants to make a career in investing not to get too emotional about any one deal or any one company. This is my view. This is my style. If you get too emotional about any one company, any one investment, and you sort of are biased and you don't want to exit it at a reasonable time, or you think that they are the best, it can backfire. So you've got to be prudent about it. I'm not saying you can't take risks. You're in the business of taking risks, so you should take risks, and this is also a risk. Postponing an exit to get the right value out of it is also a risk, but you've got to price that risk prudently. You can't be blinded by passion and say, oh no, if I exit this company, I'm abandoning the shareholders of the company, or abandoning. You're not abandoning. You're a venture capitalist. Your task is to invest. Your task is to support the company long enough, and then somebody else. Keep in mind, in most of these exits, some other venture capitalist or private equity is coming and buying your stake. Or if it is IPO, the public market is buying your stake. So you're not abandoning the company at all. You're handing off the company to another set of responsible shareholders whose task it is now to oversee the company and help it grow. So I would follow a strong discipline. I think somewhere in there I talk about it. Portfolio construction and portfolio management. Did I? If I didn't put it in there, it's very, very critical as a venture capitalist to have that discipline. If you're going to, but in your own case, it's debt. Your own case is probably a unique. We can have an offline discussion. I'm happy to share a color. But on a general basis, when you're creating a portfolio, you're going to have quite a bit of discipline in doing that.
There's also another aspect. I don't know about the US markets. In the Indian market, every mandates are like for the fund.
Yes.
By the mandated period.
That is same in the US also. There is structures, and funds have 10 plus 2 or 10. All that is there. Yeah.
Even if you don't want to exit, you have to exit because the fund life is
See, this is a valid point he's saying. Funds have constraints, they have a target time horizons, and all these things are done thoughtfully. SEBI also has put these rules in there to protect shareholders in these funds so that investments are not held indefinitely. People have a clear view to produce a return for their shareholders in a period of time and hold it responsibly and all that. What could easily happen is, if it's a smaller ticket size fund that puts 10 crores, 5 crores in each deal, and then their time horizon is 10 plus 2, something like that, somebody else who's a larger fund can buy their stake, 2-3 investments, 2-3 investors, 10 crores. Somebody else who has a 50 crore bite size can buy their stake at that point. That happens a lot. So then they take over. So it is actually seamless. It actually happens. Very rarely does a fund, if they're reasonably well managed, will have a fire sale in the 10th or 11th year because they didn't do exits. Because people know that this is the hygiene and this is the process. You've got a plan. Typically, when I invest in a proper venture capital fund, you have a 3, 4, 5, 6, 7, 5, 6 year horizon. Okay. In fact, when we invest, part of the investment thesis is you think about exits on day one. When you're going in, you think about exits. You understand how can this exit? What form can it exit? What is the time horizon of an exit? It's all a thought process. Almost always it doesn't go according to any plan that you have made, but you've got to constantly be on the watch for it. I typically do something called an exit watch for every investment. That exit watch starts after a certain number of years. That depends upon every company we invest in. Very rarely will it be under 2-3 years. You know, you got to give it time, etc. So around that time, when the value is reached some number, some reasonable number, we go into exit watch. Okay? Because keep in mind, unlike a public share, you can't just exit whenever you want. You can only exit to some other shareholder who's willing to take your stake, who's an investment fund, private equity fund, or venture capital fund, or it can be IPO, or a strategic. A strategic can come and buy your company. These things are, they don't happen on a clock. You've got to wait for them, you've got to watch them, and some cases you can put them together. You can influence them and put them together depending on your shareholding, right? But it's a process. See, I start a process in my thing, the way I do deals, exit watch, and we go on a watch and keep looking for opportunities. And the next time the company is raising growth capital, a larger amount of money, a larger round, then we talk to some of those investors to see if there's a chance for us to invest it's time to exit, in 4 years or 5 years or something like that after you produced a decent return. So exiting is as important as investing. Unless, of course, you've made the investment for a strategic reason. Think about it. Think about it. You're a company. You're making tires. You're a fantastic tire company. And this company that you're buying a 60% stake, something like that, makes some little tool or process or something that will make your tires cost 4% less. And you're reaping the profit. Now, at that point, in that situation, you didn't invest in that company for the sake of simply producing multiples of return at exit. You are harvesting a lot of extra profits. So there you may want to buy the remaining 40% yourself at some point of time. Or you may say, no, the promoters need to have enough skin in the game so they can get other companies to come and give them business so they continue to innovate. And this thing can be a strong utility for me. Now the downside is other competitors can also use the same service. Okay? So, you've got to look at it uniquely in that case. In that case, you're probably not thinking so acutely about an exit after 3-4 years because you got some other considerations. But as a venture capital fund who has a fiduciary responsibility, like he said, 10 years and things like that, you've got to run it like a fund. Okay? If you're a strategic, it's a different lookout. Yeah? Yeah.
So my question is actually about the entry to the startup. So right now the startup culture rising rapidly. How would you as a venture capitalist the screening process as to how exactly get in which industry or which company to actually get in? The amount of startups that are rising, it's been all the more difficult to take that form.
Yeah. I think what you're saying is there is a very large number of startups, basically opportunities. How do you prioritize your investments, right? See, typically venture capital funds have some criteria built in them when they launch a fund. Some funds, for example, in the current role I have, I'm looking at companies with technologies, businesses linked to financial services, fintech, data, analytics, AI, things like that, all linked to financial services because that is my current role. So I have a mandate and I will stay within that fairway and look only in that. It's very unlikely that I will be buying an equity stake in a new coffee shop or a tire company because that is not my mandate right now. All right? But there are certain venture capitalists, like the earlier role that I did, where Girish also worked with me. We were largely B2C companies. Any B2C company was okay in that. It could be a coffee shop. Coffee shop is okay, right? A tire retailer is okay. We didn't invest in any tire retailers, but a tire retailer, if there was such a thing, B2C, is okay. But a tire company is probably not okay with factories and things like that. Probably. See what I'm saying? So typically a fund, a venture capital fund, most of them, have certain boundaries within which they invest. There are some venture capitalists who are SaaS. They like SaaS and they like fintech, blah, 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 blah. They stay within that. They don't go outside that. There are some venture capitalists who will stay in defense technologies. They stay within that. Because, I'll tell you why. When you look at large cap investments, some of you may be asset managers. A large cap investor working in an asset manager, they can invest in a large cap in cement, a large cap in power generation, a large cap in retail. Doesn't matter. They are buying the listed market. They evaluate the company, which got nice float, broad shareholding. See what I mean? And they're buying a stake. That is a different set of skills. Here, you are investing an outsized amount. There, they will not buy 10%, 12% of a $30, $40 billion company. They are buying 0.5%, some small amount, right? Here, you're buying 10%, 15%, 20% of a small company. So it's very important to have certain depth of knowledge. The team that I worked with earlier, we also did fintech. Fintech was also part of what we did. But B2C fintech largely, not B2B fintech, right? B2C fintech like a MobiKwik is B2C fintech, right? But B2B, there are so many companies that help banks, that help insurance companies, that help lenders. That's huge. Software, claims, underwriting, so many are there. We didn't focus on it, okay? So everybody has a focus, and you're putting quite a bit of money as an ownership in a company percentage. It may not be large amounts of money. It's a large percentage of the company you're buying, meaningful percentage, 10, 20% of a small business, which means you need to have some depth in that vertical, in that sub-vertical, in that niche. If you don't have it, you won't do it. You would stay away, generally speaking. So venture capital is almost always a specialized business. There are some venture capitalists in Bangalore, in Silicon Valley, who will say, I will only do B2C platforms. I will only do SaaS. I will only do fintech. I will only do, some of them are so specific. I will only do platforms. I will only do quick commerce. So there's all these fine little things. That's because they have deep knowledge, understanding the business, understanding the challenges of scaling that company. And the other thing is some of the people who lead these venture capital companies, they are people who would have been executives in these companies who have now gone on to do this because they have depth. You see what I mean? They're not generalists. So the answer to your question is, how does one view that? You've got to have that knowledge inside that silo. Either you have it because you're from that industry, or you have it because you surround. See, I'm a generalist. I'm not like from any one of those industries. I'm from financial services. So financial services, I have some knowledge, okay? But I've been an investor now for, 18, 20 years. So when you become an investor and you go more broader. So my vertical stack knowledge in financial services is not as well developed as some people who have spent those 18, 20 years in financial technologies. So what I would do, I would listen to people. I will talk to experts. I'll talk to leaders. And I would try to learn as much as I can. And I'll take their input, okay? And then form my investment views. So generally speaking, most venture capitalists are somewhat specialized in certain sectors and certain sub-verticals they focus on. Or if they are large venture capitalists like a Sequoia or people like that, they have specialists. They have some partners, some teams that will only focus on this. Some teams will focus only on this. And then the other thing is they will have a bench of experts on their roster who will advise these teams. So that's how it works. You rarely go in there and invest without knowing that level of depth in venture capital deals because you're taking an outsized risk. Yeah?
How do you evaluate a company from a non-financial as well as a financial side?
When we diligence deals. It's actually an extension to what I just answered her. You are taking an outsized risk, and your ownership is a significant percentage of these small companies, which then means you need to go deep into the process that this company follows to complete their task or the product that they manufacture. And you've got to develop a very, very granular understanding. You can't just buy stock. For example, I don't have a granular view of how Reliance refines oil. Do you? Very few people will. How many of you own Reliance shares? RIL. Don't be shy. How many of you own the Nifty? Nifty, just the Nifty. The rest of you, you do. You don't know about it. That's all. Okay? If you own any instrument, it is there. And then you own Reliance. That's what it means. Okay? My point is, you don't know about refining, do you? But that is because it is a very well-formed industry and you're owning a tiny, tiny, tiny piece. Now, if you're going to buy 10% of Reliance, you've got to know it. That's what you're doing in this. So you will have such expertise either in your team. I have met venture capitalists, even recently, who have such tremendous depth in a certain vertical. They can talk to specific strategies of their companies they have invested in and their competitors, and how their company's strategies stack against those competitors, and what they are doing to beat somebody or get better than somebody, and why their strategy is superior. So that level of knowledge is required to do this. Without that, yes, I know companies ask Ernst & Young, Price Waterhouse, these companies to do diligence. They do diligence. They can do good business diligence, they can do accounting diligence, all that they can do, even financial diligence. But to do this business diligence, to understand the technology, the product, the process, how it is unique, how it creates value to their customer, right? Or whether it is a B2C company, that's end user customer, or it is a B2B company, their client. How it creates value, how they price it, how a customer makes money with this, whatever service they're giving. They've got to have that level of understanding. And typically in venture capital, I find such experts come from within. Okay, they are very senior executives who know it, or they bring experts. And it's entirely possible that in software and technology, there are specialist companies. It could be your Accentures, could be your Price Waterhouse, Ernst & Young, I don't know. They may have specialist teams. They come in and provide such insights, okay? So you've got to get it. You've got to have that. This diligence is a unique one-off thing. It's not like cookie cutter. You can't just look at stock reports and understand P ratios, price to book, blah, 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 and buy it. This is not that. This is inexact science. So you've got to go deep into it. You've got to put your head into it. And that is why it is a specialist industry. That is why people take years to fine-tune their skills in it. They focus on it. They spend years, and they develop all those skills. And you have to build that ecosystem of people who can provide that diligence for you. So, for example, I call friends, and I call people and say, hey, I'm looking at this company. You're working in this space. What is your view on it? And then that person may say, listen, I have a preliminary view, but she, on the other hand, she knows this space very well. You should talk to her. And he'd connect me to her, and then I'd talk to her, and then she'd give me more granular views. I've got to do that. There's no other way to properly diligence. Diligencing is a task. It is not an easy thing, which is why, I mean, listen, when a company is out there raising money, you don't have 800 people chasing it to put money in. You probably have, a dozen, something like that. It's because of that. And when a company is taking capital as well, a lot of times the company wants to take capital from such investors who have some vertical knowledge. Because that's very important. Because as the company is growing, it goes through difficulties. It goes through growth challenges. And when I have a shareholder who is empathetic to my challenges, who knows they can either help me or at least not harm me. Okay? They can help me, they can connect me to her, for example, and say, she can come in as a consultant and help you. They could do that at best. They could introduce me to him. Hey, this person could use your services and you could be a client and get some business. At a minimum, what they won't do is if they'll have empathy for my challenges and not say, show me the numbers tomorrow morning. They'll give me some runway to perform. So it's a lot of times venture capitalists look for, companies look for venture capitalists who have some subject matter depth and knowledge before they choose them to be their shareholder. It's both ways. Wealth management company.
People need, doctors. So people need us even after building portfolio of say 50 lakh rupees or 1 crore. Still people want to have second opinion. So that is where our
second opinion for what?
With respect to the investments, reviewing their portfolios. So in the wealth management domain, so even personally I would have limit to my bandwidth, so I can cater to say 50 or 100 families in 1 year. So obviously it's people's business. So even we need to have a big team to cater to many families. So while and paying the salaries to those to our relationship managers is a very big chunk in the wealth management domain. So my personal question is, what should be the prerequisites? So say after 5 years or 3 years down the line, I want to raise funds for my own wealth management firm to grow it bigger, to hire more people, to pay salaries, to move to a new bigger office, so what should be the prerequisites? Which things should I take care of, in next 2 to 3 years or 4 years before going to VCs, or private equities to raise funds?
So are you a boutique wealth manager managing some capital and a bunch of clients, you and some partners type thing?
Yeah, so it's my own, so I am the only, so we have a team of say 4 people right now, who advise families for their investments.
See, it's interesting. I did this business before in my life, so I have a little bit of knowledge. I'll give you some very generic pointers, and I'm happy to chat to you specifically after we finish, because it may prevent me from answering others' questions if I go too deep. It's not very different than any other business, okay? It's about understanding where you are, what your opportunity set is, which we all know in wealth management is very large. In India, our people's incomes are increasing, and we don't have a tremendous social security net in India. So as a result, you have to save. When people have to save and invest capital, they need help. So this category called wealth management is growing. The big companies are doing it. The big institutional brokers are all doing it. Companies like Grow are doing it, right? And then there's a lot of boutiques that are starting up everywhere. Now, it has standard normal scalability constraints. One manager can only manage a certain number of clients, 20, 30, 40 clients. You can't manage 400 clients. You can't give attention. But at the same time, if you have a robo-advisory capability within that, a good technology platform with robo-advisory ability, where you have an advisor that's able to transmit certain amount of their communications using the robo-advisory ability. I'm talking about a hybrid, not a pure freestanding robo-advisory. The same advisor that's able to handle only 30 clients can go do 50 clients, okay? And you also have to segment your clients. There is a certain segment of clients who will want that face-to-face advisory. They don't want it on an app. There's a certain set of people at this end of the bookend who are totally fine with that. So it's very important where you want to play in this, how you want to use that technology, how many people you want to hire. All those things go into the mix of your business plan. And you build a business plan for 3, 4, 5 years time frame from now and say, listen, I am under so much AUM, assets under management. My revenue is, I don't know, X crores today. My EBITDA is 0.25 X crores today. 5 years later, my revenue is going to be 6X. My EBITDA is going to be 0.35 of 6X because I'm achieving scale, I'm using technology, I'm going to make more profits, right? All this stuff. And to achieve all this, I need 1.5X today in capital. And I value my company so much, and I'm willing to give up so much of my company. I want this capital, blah, blah, blah. So you create a business plan, not unlike a SaaS company or anything else, or a coffee shop. You need a plan, a clear business plan. You need a business plan for you anyway. Forget about capital. You need a business plan for you to run that business and take it from X assets under management to 6X. You need that. So you develop that plan, and in that plan you will have all this connective tissue that I talked about. Your approach, robo-advisory, software, SaaS platform, whatever else you will do, advisors, training people, okay, recruiting, customer acquisition, customer servicing, all of that stuff, compliance. Now, and then you find venture capitalists or private investors. Keep in mind, something like this, you could get your own client base. You're a wealth manager, okay? So fundamentally, your clients have wealth with them, right? So it's entirely possible that one or many of your clients like you so much, they're willing to invest in your company. They are using your company. Now, I'm giving you the way my head thinks. If I were you, the first thing I'd do, depending on how much capital I need in your scenario, let's say it's a reasonable amount of capital and not like $30 million. Let's say it's a reasonable amount of capital, then I would say, okay, I have 60 clients now. These 10 clients are my large clients who know me really well, who have a very strong view of me. Now, if I'm going to grow and succeed, I'm helping them. I give them a chance to put in some capital in my business. And then I would do it exactly like a venture capital. I'll create an entity. They'll all buy shares in that entity, and that entity will own a stake in my entity. So it's all clean. You know what I mean? Just like a venture capital, no difference at all. And then when they have skin in the game, they may refer you to a few more clients. Now think about that symbiotic relationship. They not only make some dividends when you succeed, they can also help you. And they can help themselves make that dividend a little bit more. So you've got to think like that. It could be. That's one way to do it. So another way, no, but I don't know if there is a compliance thing that says that your clients cannot own shares in such a business. No, I don't know about that. If that is there, then you can't have it. But you've got to think through like that. You've got to think through what is the quickest way to get home. Not to say like, oh, I need a big plan, I need to raise $20 million. Don't think like that. Think about, this is where I am, this is where I want to be, what is the smartest way to get there? Just try to put a simple, playable plan, you know? When you have 50 overs and you have to score 220 runs to win, you don't need to hit 3 sixes in an over. You just need to play carefully, reasonably, and win that match. It's not about acrobatics. But at the same time, if you need to amplify your run rate to move up that league table, you have to score that 200 runs in 30 overs, 35 overs, instead of waiting till 60. So that's a call you've got to make. But once you've made that call, you don't need, I see a lot of people make mistakes like this. They are building a business For their business, it may be easier for them to go to this category of investors who will readily invest, give them money, etc., etc., etc. Instead of doing that, they say, I want these fancy investors to give money to me. And they're going, barking up the wrong tree. Okay? So it's very important to find the right match. It's not unlike a marriage, man. It's like, we've got to find the right match. So it's very important. So that's how I would think. I'm happy to give you a little bit more colors if you tell me specifics offline. Okay? Thank you. Yeah. Let's ask him. He's not asking. Yeah. You're also a wealth manager? Deals meaning, do you invest in funds or do you invest in straight into deals? Okay. Coming in. Huh.
Now the terms that they are coming with are so harsh. Like for example, they will have terms like fall away of price if your holding percentage goes below certain level.
Yeah.
Or our investors lose right of first reflection or voting rights, etc. Is it normal or is it because the capital has become costly today from what it was 4-5 years ago? So I want to know, like, should we be expecting this? Because I see that more of our investors will start investing in such deals, and they will typically come at angel stage and would like to exit at Series A or PR. So should we be expecting that, and is it a signal that we should be getting out at the point when such a big investor is coming in, or this is one-off case? And secondly, is there, like, from your vantage and vintage, to what difference do you see between capital raising in India versus in US? Because most of the companies that we come across, they start with offices in India as well as in US or maybe Singapore, and mainly because they find it easier to raise capital abroad than in India. So what are the impediments for this industry?
Good questions. The first one is a real issue. I myself, when we invested in companies, we've seen angels who have invested in the company earlier. And in some cases, I have walked away from deals because I didn't want to negotiate with 8 people. There were 8 angels. They were not as one block. They were 8 different people. I'm in the business of deploying capital. I told you I'm not emotional. When you are running a large fund and you're doing 20, 30 deals a year, you're not emotional. You have to get your job done. So I'm going to see, I want to deploy capital, I want to invest in Jugal's company, but if Jugal's company is going to give me chronic headache for 6 months, I'm saying, all right, mate, I'll look at his company. I've got to deploy capital, right? Put yourself in my shoes. I've got to do my job. So it is a challenge. So from a venture capitalist standpoint, when a company is very young, they have an idea, they have typically a young team, unlike the team that you mentioned, second, third generation. Most of them are young team, new idea, energetic. They want capital, but they're not able to get capital, so they go get a few angels, friends, family, things like that. And they don't really know that much about rights and terms and conditions, reps, warranties. They just don't know all that well, which is reasonable. Some of them are serial entrepreneurs. They have built companies, they have exited, and they're starting another one. They would know. most of them are not. So when they're not, they don't know. And they will probably sign on things they should not have. Okay? And then, now they have reached a certain size. Now I'm going to put 30 crores, 40 crores into it. Obviously, I'm institutional capital. I'm a fund. I need a ROFA, I need, drag, tag, blah, 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 blah. I'll need all that, right? And if somebody is going to stop me, saying, no, Sammy, you can't have it, I'll not fight with them. I will say, okay. I'll go to the promoter and I'll say, listen, mate, this is my challenge. I need this. Without that, I can't invest. So we'll try our best. If we can't put in that, if we can't get some of those key rights, we will walk away. But chances are, in 90% of the cases, between our teams and the promoter and the angel investors, there is a discussion. And in this case, you are their advisor. You're also a reasonable guy. Promoter is a reasonable guy, and we are reasonable guys. So you put a group of 3 sets of reasonable guys in a room and then say, listen, we're all here to make money. If he doesn't get money, he doesn't survive. Your shareholders need our capital so you can make a return. We also have to deploy our capital. So everybody is in there to make money, right? So we can all love each other or hurt each other. So we start with that view, but I've never seen 3 people agree in a room. It has never happened and it'll never happen. But in the end, if there are 8 clauses, we will all get something and we'll walk away. This is my trade. This is what I'm good at. And this is what I do. I fully believe I'll never get everything I want. If I did, there's something wrong in that deal. Okay? Because either the company is in a bad shape or whatever it is. Because generally, promoters want something, other investors want something. I also want the whole world and the solar system and everything. So we all negotiate. We all sit around like sensible people, and we can never, see, negotiating is an art that is never taught in CFA or in business schools, or there are enough people in airline magazines that say, I'll teach you negotiation. Nobody taught me. I negotiate all day long. That's my job. But the most important thing in a negotiation, I would say, is I've got to respect you and I've got to respect him, and you both will have to do the same. And then if we all respect each other and we all want to do the right thing, for who? For the company. We all want to do the right thing for the company, we'll get it right. Our head's got to be in the right place. And that is the job of the 3 sets of people to do. Because there is, in my opinion, absolutely no term, no right, no agreement, nothing so sacrosanct that the company should sink or should die. We should help the company succeed. That is the single most important objective in this. Company needs capital. Of course, your shareholders need your rights, but I have seen too many cases where some terms written this way, that way, create such a long discussion that some venture capitalists will say, listen, I don't want to discuss. I'll come back when you guys settle. So these things happen, but typically the promoter intervenes with the angels, because you've got to, this is something I would advise you. You please tell your clients when they invest, some of those rights won't hold water as the company matures. Think about it. Somebody put in 30 lakhs and the company has succeeded. The 30 lakhs is worth 2 crores. Okay? And then I'm coming in putting 50 crores. I'm taking a larger bite of the company. I'm taking a bigger risk. I'm going to ask for certain rights. If you put 20 lakhs, 30 lakhs, and then you're stopping me, you're hurting your investment. You may never get your 2 crores back. Okay? So you've got to be able to convince your clients that, listen, you have this right. You know, you have a dog. I have a dog, a guard dog, an Alsatian or something to protect me when I'm an executive. Tomorrow, if I become a minister in the Indian government, do I need a dog to protect me? I'll have enough soldiers, yeah, protecting me. security. That's how you think about it. So you have certain rights for certain reasons when you did those agreements. But now the company has reached a size and maturity that other institutional investors are coming, and that in itself is a protection for you. Look at it that way. Because we also want returns. So as long as the valuation is reasonable, we are aligned, we're not doing something completely adverse to the company, and we are good guys that will help the company succeed, we are aligned. You have already made a 6x. You could make another 2x beyond that. That's a 12x, man. Just be happy and say a prayer. Take your money. Just keep in mind, you should not get emotional. You should simply focus on getting good risk-adjusted returns. That's the main thing. As long as you're that way, you don't get carried away by a single right or a single term, everything is okay. I've never lost a deal because of this. I always ask people to negotiate reasonably. And most people are reasonable. Very rarely are people unreasonable. Very rarely. Your second question, a huge amount of the capital that has come into India in venture capital, in the last 2 decades, not the most recent one, the ones before that, has been foreign. Because, see, venture capital, for a venture capital ecosystem to succeed, you need 3 things. One thing you need is capital. Without paisa, companies don't grow. 2, you need innovation. You need innovators, people who create ideas, new ideas, start new companies. These are innovators. But the third is a very important and yet less spoken one. These 2 things everybody understands. The third is the early adopter ecosystem. Now I'll tell you what that is. How many of you have a smartphone? Everybody, right? You go to Silicon Valley, where they made the first smartphone, right? I don't know which one is the first smartphone. Is it a BlackBerry or is it an iPhone? I don't know. Depending on which one you qualify. It's either Canada or Silicon Valley, wherever they made it. I don't know. That's not the point. The point is, when the first phones were made, it didn't have any of the functionalities today's phones have. But they also costed $500-600 in those days. There were some people who were willing to pay that $500-600, a lot of money in those days. I'm talking 2004, 5, 6. People paid that much money and bought it. They took a chance, right? And they played with it. The company got data, the company learned, the company innovated, the phones became better. These people are who I call early adopters. That's all. I'm using crude definition to make it simple. Somebody is willing to take that risk. We talked about venture capital, where the venture capital is taking risk with her or his capital. We talked about the promoter. Promoter is taking risk with her or his career, leaving a job and starting a company. But the early adopters are the first set of customers who are also taking a risk with this company. You must have all heard the statement, nobody got fired for hiring IBM. Correct? Because you have a problem, you're a manager in a company, you've got to build a software, a system, you hire IBM, IBM does it for you. That's how they used to say in America, where here it's TCS. Okay, it doesn't matter. These are large companies, they do a great job, right? But how many people will give a chance to a small company that says we are innovative, we are great, we do it cheaper than the big competitor? If you go out of your way and hire that company to do the system integration for you and it blows up, you have egg on your face. Now, if you have thumped the table, if you have fought for that and that convinced your boss that you have to give this company a chance, it's a great idea, it save us money, they'll do well, you are an early adopter. Okay? So an early adopter could be somebody who pays for a phone that's not proven, who is willing to do a drug trial, take a drug or a medicine or a procedure on trial, or somebody who gives a contract to a SaaS company that is small and new and untested. This is very, 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 very critical. And generally speaking, in most innovations, especially technology-based, technology-driven, this kind of innovation. Countries with a higher per capita income tend to have more early adopters. It's very simple. If you're making $80,000 a year income, for you to blow $500 is one thing. If you're making $8,000 a year, to blow $500 is a lot of money. So you may be willing to blow $20, but not 500. So that is the reason why a lot of these innovations happen in countries with higher per capita income. And in the early, but of course, there are innovations that have happened in India. But those are unique to our needs and our requirements. We make, I don't know how many tons of bhujia a day in Bikaner. I'm talking serious stuff. I looked at investments in this space. Okay? I don't know how many of you are from Rajasthan. I am not, but I like that thing. Right? It sells a lot. It's made in tons every day. This is serious stuff. Now, that innovation is not in Silicon Valley, guys. That is here. So we innovate for what we need. They innovated for what they need. That's all. But the point I'm saying is, in this technology space, a lot of these innovators, early adopters existed in those countries. As a result, Nokia came out of Scandinavia, and Apple came out of Silicon Valley, Microsoft came out of United States, and things like that. That's all. No other reason. So we will also have those innovations now, because our per capita income has risen tremendously. We have a good 100 million people in India, depending on whose count you take. This is why I don't go into putting billions and trillions in data, because depending on which way you measure and count that data, you'll get a number here, a number there. The reality is it's large. We have at least 100 million people who can take $100, $200 commitment for an early adoption risk. Correct or not? Okay. That's a lot. 100 million people you can add. The state of California has 40 million people. So it's bigger than the state of California, right? Now to that you can add Holland. You can add a Germany to the state of California, and that's 100 million people. So what I'm talking about is we have a critical mass of early adopters in our country now. As a result, what you will see is Indian venture capital come in a huge way. What you just now said, your own clients wants to do angel investing. They are early adopters in venture capital. They are coming into venture capital. They are asking you for it. They would not have asked your predecessor in your job 10 years earlier, correct? Because they want to get a piece of that action, right? Those are early adopters. So as that comes in, if you take the United States, we talk in India FDI. How many of you have heard FDI? Everybody, right? Into the United States, if you read their papers, Wall Street Journal, Financial Times, whatever, they don't say so much about FDI. Why? A lot of it is local DI. We will also have it. It's a matter of whether next year or the year after or 5 years. But we have a huge amount of Indian capital coming in. The largest capital in our country will largely be Indian very soon. Others will invest. Others are seeing growth in our economy, opportunities in our economy. They will invest. I'm not saying they won't, but Indian capital is coming. Indian capital is surging. We have a huge number of people with a lot of capital, with our financial institutions, our individuals. They own the money. That money will come in. That will fund these opportunities. And that is this hockey stick that I showed in a couple of earlier pages. Those are all important ingredients in the hockey stick. The early adopter ecosystem growing, the capital base increasing, and innovators. We will not suffer this brain drain that we suffered when I was a teenager. We had to run away. Yes. If you really wanted to work in high tech, you wanted to do something innovative, you had to run away in those days. We had very limited opportunities and a lot of people wanting them. Today, you don't go anywhere. We have tremendous opportunities for everybody. Start companies here, capital is available, talent is available. I mean, every one of you in the next 10, 15, 20 years are going to see massive companies. It's going to be shockingly amazing. I mean, I'm telling you, it's going to be shockingly amazing the next 10, 20 years. I would say it's a golden period in our economy for innovation and venture capital. So those of you who want to enter this industry, this is the time. Any other questions, or you waste all of your time so far? Go ahead. Take your microphone, yeah? Yeah? No, more than a couple, hopefully.
Maybe 10, 15 companies. And each of them will have their own life cycle. Some would go faster, some would go slower. Also depending on the industry in which those companies are.
Yes.
So how do you identify slow movers? And if they are not moving as per the business plan submitted, what steps you take as an investor?
Identify slow movers, they identify themselves very fast. Right? We do portfolio management. That's a very important part of a venture capitalist job. So we'll have to monitor these companies on a regular basis. Just like how we monitor our children. Same thing. People make big deal of all this. Huh? They say, I'm this, I'm that. It's more simple. You have to, when you put money, until you put money in that company, it is their problem. The moment I put money into the company is my problem. Correct or not? I've given them money. Now I'm sitting here, sleepless, waiting for the money to come back. It's going to take time. Correct? Which is why I said exits are very key. Okay? Now, we monitor this portfolio, company by company. We keep an eye. We meet the management team on a regular basis. In some cases, on a monthly basis. Most cases, on a quarterly basis. We get financials from the company. We may do Zoom calls. We don't have the bandwidth to meet them every month. We'll get financials, emails, and you monitor those financials, goals. On a quarterly basis, at least you know the progress of the company, how it's going. And then you look for early signs, if they're slowing down, things like that. And then you start flagging them off internally. Now you know. Now, the honest truth, you can't do a whole lot. Your money is put in. If you can help them, you can meet them and they can say, hey, listen, I want some introduction to clients. Or I'm having this problem. I need some more capital to build this thing out so I can add value to my clients. Or I'm having this problem. Or there was a fire in my factory. It could be so many reasons. To the extent you can help, we help if we can. But 80% of the cases is very difficult to be, practically I'm saying, to do something remarkably helpful that can change that outcome, okay? It's very hard to do. Because these promoters are very bright. That's why they've started a company, they've quit their jobs, they've taken a risk. And they've figured out everything they can. So you do your best, you help. In some cases, okay, so then they may need more capital, we may help them get more capital. They may need talent, we may help them get more talent. So we all fight together. And in some cases, what we try to do is, okay, I have this other company in my portfolio. This company is interesting. Why don't you guys talk to each other to see if there is some way for you to work together, become a larger company, okay, manage some costs. See, when two companies combine, you can reduce some costs that are parallel, overlapping between the two, right? Finance, HR, things like that. You can combine to the extent that Sachomajo makes sense. This is not a silver bullet. But venture capitalists sometimes do things like that. If they own a meaningful stake in this company and a meaningful stake in that company, then they say, hey, why don't you guys come together so that you both help each other and then do that. And in some cases that works out. And then the company comes out and does well. In some cases it doesn't. So there is no straight line answer for your question. But we try to do whatever we can to help, okay, in a situation like that. But that in itself is a risk. That is a risk of this kind of investing. It is unlike buying a stock in a public company where you put 1 crore, you bought shares in this company, company's EPS doesn't meet target, company goes down, company doesn't have a great outlook, let's say, you are able to sell it. Let's say your 1 crore has become 1.2 after 2 years, 3 years. You don't see a long outlook. You sell, you take a little profit or a little loss, you walk away. You can't do that in this so easily because this is not a liquid market, right? So it's very difficult to sell and leave. Okay, I'm sure you try to do that too. If you see at some point somebody wants to come, somebody says, I have this company in my portfolio. This company can benefit from this company. So, okay, you put in $20 million, I'll pay 17 million for your 20 million, I'll buy your stake, and I'll combine this company with this. At some point, we might have to sell and go and take that licking. Or else, you can say, okay, I'll sell, I'll dilute myself, I'll have a smaller stake in this company, and I'll ride with your risk. So those are all, there's no straight line to, there's no clean answer for it. But you got to do the very best you can. Okay? Yeah.
Sam, thanks for this Saturday delight. Just firstly, my day job, I usually network with people and speak for my clients, maybe with my team as well, right? And business usually happens in between those things, right? And just before asking,
your day job, you said,
I just network with the peoples and beat my team or beat by the industry people or my clients, and business automatically happens in between the things. As long as I'm clear what I need to talk with.
Well, what business is that?
It's all about wealth management thing only. Wealth management, right? And just to answer maybe pointers to his wealth management thing, as you rightly said, like as long as you're clear with your plans and all going forward, you already have those sort of clients available with you, right? If you can put your right ideas behind those people and you are feasible enough to understand that these clients are in a good shape to fund you with your plans, it automatically works, and that we also saw in our farm. And just to maybe somewhere what I have some understand from his point of view is that I think it's not a generational thing or maybe problem he's asking about. Is mainly technically he wants to ask you from is that what you will do if you have funded somebody and your visibility of coming back that money is very lesser.
Very
less. And you want to fund him more to pull it that money back to you, right? This is what I have understood from his problem. Now my question is different. Like I want to understand another leg of private equity thing is that you guys have talked about investing in the companies and all. But my point is towards the investors who are there with you. Not the companies. I want to understand.
In the company or in the fund?
In the fund.
In the fund?
In your fund. Who are the investors? I want to understand that leg, since we are working on that.
Investing into funds.
Right. In your funds, let's say, the investors who are in. I want to understand that territory or maybe that leg, how you guys operate and what are the difficult challenges you face. Because I have seen a lot more high-end clients, maybe they're very blunt and with their investing, and they are very cutthroat, I would say, which they have money with them, right? And if even they don't want to pay you big, even if they sometimes they even want to have pieces from your own brokerages as well, right? So how you work around in that territory with your own investors, not with the companies. I understand the company model. I want to understand the other leg of the private equity thing.
So in the interest of full disclosure, at the moment I don't run a fund. I work for a company. Okay, we are not a fund. Bajaj FinServ is not a fund, just to clarify that. So I'm not doing that, but I've done that before, right? So when you take capital from any investor and you manage that capital, you deploy that capital into a venture capital company, venture capital funded companies, you are a fiduciary, right? I'm a custodian of that money. So you put 30 crores in my fund, you put 20 crores in my fund, you put 50 crores in my fund, you put 100 crores in my fund, I've raised 800 crores. Now I'm investing that money into venture capital funded companies. Now, I typically write an agreement with each, pretty much the same agreement, right? The amounts are different, which will say you have put in money into my fund and you will pay so much management fee per year. You will have this type of returns. When returns come, I will give you so much return. This percentage of the return will go to the managers of the fund. This percentage of the returns will go to the investors in the fund. And then you have certain information rights. meaning I would provide you a summary of my portfolio's performance every quarter. Maybe I agreed to provide a face-to-face meeting or Zoom meeting or things like that once a year type thing, where I give you more details, more deeper details into my portfolio companies, how we think through portfolio construction, what are the big themes we look at for the coming year, how we choose companies, how we make investments, how we monitor that portfolio, okay, how we monitor, provide oversight, etc., and how we exit, all of that. So we go through it and then we talk about what happened in the last year and what we are planning for the next year type thing. It'll be a whole day long thing in many cases. And then they get to ask questions too of us, how you think through this, and all that. So that'll be a document. It is called an investor memorandum, which you probably know of well if you have clients investing in this. Now you will review that document before you advise your client, this fella, to put in 80 crores. Now, you as a wealth manager, if you don't agree with those terms, you can come and ask me, listen, I want this different this way. And I can say, listen, I agree to this. I am willing to do this. Or I say, I'm not willing. I don't want your money. So those are discussions that can happen. And in the end, we both have a handshake and you deploy the capital and then it goes by that. And then the rest of these things happen. Now, this is standard. There is nothing in this that is non-standard. Things go bad only when what happens is when some things in this that are agreed upon are not followed in the event of a deal, or some deals go south, large deal, and some investors are unhappy and they voice their opinion. All those things happen. So this investing is not like buying fixed deposits, treasuries, or equities. This is different and this is unique. This requires a lot more management oversight effort. That's what it is. Yes. Manage it very carefully and cautiously and carefully. It's not easy. I agree with you because a fund needs capital. So you have to go and raise capital. Now, every fund wants to raise the right amount of money in the right time. Now, every investor wants returns. So we've got to create that matching. But then the rights, the terms, listen, I'll tell you, if a fund is 800 crores and somebody is putting 600 crores into that 800 crores, they are going to have an ability to get rights that somebody who puts 20 crores will not, right? Am I fair? Okay. So it depends on that also, okay? Information rights and all this. So, you know, man, it is like supply and demand. That's all. Okay? It's not linear. It's not a straight line. There is no cookie cutter contract that everybody signs. That doesn't exist. Every contract is unique. But I can tell you that increasingly more and more people are coming into it and investing capital. But I will also say this investing is not for everybody. Okay? This is not for everybody. Okay? This is not like buying fixed deposit or simply buying the Nifty or things like that. You could get your hands bloodied if you take outsized risk and things can go south and funds have lost money. This has happened, okay? And this will happen again. That's assured. Okay, some funds, some periods, one fund can make a lot of money in one vintage and then another vintage they're not able to exit, the fund has lost money. So when you invest as an investor, now I'm talking as an investor in these funds or in these type of companies, you have to fully keep your eyes wide open before you invest. And if you're not willing for that, to absorb that risk, take that risk, please don't invest. Like I always say, alternate assets are only a small portion of a large, well-managed portfolio. Okay? Very rarely are alternate assets 70%, 80% of a portfolio. Typically, wealth management portfolios, in what I have seen and experienced, people will have fixed income, people will have equities. Within equities, they'll have growth equities, they have value equities, they have emerging markets equities, right? They have developed market equities. Like, when you're an Indian investor, you may think about Europe and America and Japan, you may think about emerging markets, you may think about India for sure, which is a big part of your portfolio, fixed income. And then there is real estate, and then there's private equity, hedge fund, venture capital, all that sort of stuff. So when you look at it that way, it should be sized appropriately, okay? And then you have to be fully aware of the upsides and the downsides of investing in it. You do get some risk diversification, because these things are not necessarily always correlated with the market. I agree, you get some diversification from that standpoint. But at the same time, the risk could go against you in certain periods of time, and you gotta be aware of that. Okay? Jugal?
Yeah, we've run out of time,
Run
unfortunately.
out of time. Okay, they're going to kick us out of the room.
We far exceeded. I think we were planned till 1 o'clock, but it's 2 now.
It's 2 now.
Yeah.
Man,
So
time flies.
I would like to ask Prashant to hand over the memento as a thank you for Sam giving us
Oh God.
a lot of his time. And of course, apologies for the AC.
No, not at all. Like they say, all's well that starts well.
Ends well, it starts well and ends well.
Ends well.
Yeah.
It ended well.
I would
Thank you. Thank
Sammy
you.
very much for the
Thank
session.
you. Thank you.
In fact, we were discussing initially whether to make it a workshop or to make it a speaker session. And I think in hindsight, which is always 2020, we should have made it a workshop rather than a 2-hour, fortunately it turned out to be a 2-hour session. We were able to extend it, and it was very insightful.
Thank you.
And having, in my day job, having a look at all these asset classes, I have come to an understanding that private equity is not very much different, but yet it's a completely different ball game. Yeah. So Sam, maybe we look forward to hosting you again, maybe for a little bit more deeper discussion, for a longer session. And in the meantime, we hope you enjoy this.
Thank you.
And
Thank you.
look at it and remember us in a good way, and not for the fact that the AC conked out and we had to change the
It's all
venue
right.
through the day.
It's all right. Thank you.
Yes, 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 definitely. Yes.
Super.
Yeah,
Thank
but
you.
I would prefer to make it a Pune center kind of a thing rather than giving to other chapters so easily. Yeah. Jugal, come inside quickly.
We'll put this away here. Come, Jugal, come. Here.
Thank you very much.
Thank you. Thank you all. Yeah.
Make an announcement for lunch, please.
Lunch is arranged. There's a separate section down in the restaurant. And before leaving, please complete your registrations. Thanks.